Every bubble starts with a story that feels like a shortcut. A faster way to get rich, a cleaner way to build, a smarter way to invest, something that makes the old rules look outdated, slow, unfair. And when the story is good enough, people stop asking what they're actually buying. They just buy. That was the mood when blank checks came back in style. A company with no real business, no product, no revenue, sometimes not even a target in mind, could raise a mountain of money in public markets and promise only one thing: a deal would come later. Investors would hand over cash first and hope the right company would be placed inside the shell after the fact. It sounded like an absurdity disguised as innovation. But for a while, it didn't just work. It looked like it couldn't lose. And that's the paradox at the heart of SPAC fever. How does an empty shell create so much value so quickly? If a vehicle starts as nothing, why does it produce so many winners early on and so many losers later? The answer isn't a mystery, it's structure. A SPAC is a special kind of machine. It turns excitement into capital, capital into a merger, and a merger into fees, shares, and headlines. And by the time the public sees the full bill, the people who built the machine have often already been paid. The idea itself is older than the mania that made it famous. In earlier eras, shell companies and blank check schemes thrived at the edges of the market, especially when regulation was weaker and speculation was stronger. Money would be raised on vague promises, a merger would be announced, the stock would spike, and the public would be left holding whatever was inside the wrapper after the insiders cashed out. That wasn't a new trick. It was a recurring one. Every generation finds a way to sell the future in advance. When regulators tightened rules in the 1990s, the most blatant versions became harder to run, but the concept never disappeared. It simply evolved. It got cleaner paperwork, better branding, more respectable sponsors, and eventually it returned wearing a suit. The modern SPAC is marketed as order and discipline. A publicly traded shell raises money, places it in a trust, and then hunts for a private company to merge with. The merger takes the target public without the traditional IPO process. That's the pitch. Faster, simpler, and more flexible than an IPO. No grueling roadshow, less exposure to fickle market windows. A clearer negotiation between the shell and the target. It all sounds efficient, almost elegant. But the most important part isn't the trust account or the merger mechanics, it's the clock. A SPAC usually has a deadline to complete a deal. That timer changes behavior the way a ticking bomb changes a room. It doesn't just create urgency. It creates incentives to close something, anything, before time runs out. The closer the deadline gets, the more a mediocre deal starts to look like a successful one, simply because it exists. And that's when the machine begins to reveal what it's truly built to do. Here's how it works when stripped of the mythology. A sponsor forms a shell company and takes it public. The public buys shares, often priced around a simple round number that feels stable and familiar. The money goes into trust. On paper, this looks safe. If the sponsor finds a bad target, shareholders can vote no. If they dislike the deal, they can redeem their shares and get back their cash from the trust, plus some interest, depending on the structure. That redemption feature becomes the sales pitch. It's the reason so many people treated SPACs like free options. Limited downside, unlimited upside. If the deal is exciting, ride the wave. If it's terrible, get your money back. But that safety is not evenly shared. The sponsor is not playing the same game as the public investor. The sponsor's payoff often comes from a special allocation of equity tied to closing a deal. The numbers vary by structure, but the principle is consistent. A meaningful chunk of the post-merger. The company can be effectively reserved for the sponsor at a low cost, provided the merger happens. That changes everything. Because now the sponsor doesn't need the company to become great. The sponsor needs the company to become public. There's a difference between building value and manufacturing an event. One is slow and uncertain. The other is a transaction with a closing date. It's like a poker table where one player receives chips at a discount and gets rewarded for keeping the game going, not for winning the pot. Everyone else buys in at full price. When the hand ends, that favored player can still walk away ahead, even if the table collapses afterward, because the structure guaranteed them an edge from the start. That's the first secret of SPAC fever. The vehicle is engineered to make deals happen. Once that incentive is in place, a whole ecosystem forms around it. Banks that underwrite the shell's offering, lawyers that structure the merger, advisors that craft the story, analysts that translate projections into optimism, pipe investors, private funds that provide extra capital during the merger process in exchange for favorable terms. Each participant extracts something from the transaction itself. And this is where the story becomes familiar, because modern finance often rewards motion more than outcomes. A factory is judged by what it produces. A financial machine is often judged by what it closes. When the market is calm, that distinction is easy to ignore. When the market is euphoric, it becomes a license. The fever years were a perfect storm. Low interest rates made cash feel worthless and speculation feel rational. New retail traders arrived by the millions, hungry for explosive upside. Social media turned investing into theater. and the market's appetite for growth stories became so intense that narrative could substitute for proof. In that environment, a SPAC offered something priceless: speed. A private company with a compelling story could skip the long, demanding ritual of the IPO and reach the public markets quickly. A sponsor could promise access to the next big thing before it was ready to be measured like a public company. Projections could become the product. The future could be sold as if it were already earned. And that is another quiet advantage of the SPAC structure. It can invite storytelling that public markets would normally punish. In a traditional IPO, companies face tight constraints on how they market future performance. The process is built to emphasize disclosure and caution, at least in theory. SPAC mergers, especially during the frenzy, often created a wider runway for bold forecasts, ambitious timelines, and glossy presentations that looked more like venture capital decks than public company filings. When belief is strong, that runway becomes a highway. That's when celebrities entered the picture. Not because fame improves due diligence, but because attention is a form of capital. A famous name can raise money quickly, and once money is raised, the timer starts. The shell must find something to buy. The process begins to resemble a hunt, where the hunters are pressured by the hourglass they flipped themselves. At first, the targets were often companies with real potential, strong brands, interesting technology, credible founders. But as more shells flooded the market, the supply of truly ready companies didn't magically expand to match. The number of blank checks grew faster than the number of great targets, so the quality bar fell. Companies that would have struggled in a traditional IPO suddenly had a different door. Pre-revenue ventures, businesses in hyper-competitive sectors, concepts dependent on unproven tech, plans dependent on perfect conditions. Some were honest, but premature. Some were dressed up. Some were simply not viable as public companies. And still, the deals kept closing, because the machine rewards the act of merging. The public investor, watching tickers jump on announcement day, could easily confuse price movement with value creation. A spike feels like confirmation. A surge feels like proof. But price is not the same thing as worth. In a frenzy, price often measures nothing more than how badly people want to believe. The real test comes later, when the company has to live inside the harsh climate of public markets. Quarterly reporting, analyst scrutiny, cash burn exposed, competition measured, promises compared to reality, and reality is where the hangover begins. A pattern emerged across the SPAC's landscape. Excitement at announcement, euphoria into the vote, then a slow erosion as deadlines met physics. Revenue didn't arrive. Margins didn't appear. Manufacturing timelines slipped. Customer acquisition costs rose. The market, which once valued dreams at any price, started demanding results. That's when belief breaks, and bubbles don't end because people learn new facts. They end because the same facts start to feel real. But the deepest discomfort isn't just that many post-merger companies struggled. It's who got paid before the struggle became visible. Sponsors, in many structures, can profit from the completion of the transaction itself. Underwriters and advisors earn fees for closing. Pipe investors can receive terms that protect them in ways the ordinary shareholder doesn't enjoy. Early holders may redeem their shares, taking back their trust value, while still keeping other instruments like warrants, depending on the deal design. The structure can allow sophisticated players to reduce risk while retaining upside. This is where the safety pitch becomes misleading. Now, the redemption feature protects a shareholder who is paying close attention, understands the timeline, and has the discipline to redeem instead of chasing the dream. But the market price after the merger is driven by whoever remains and by whoever buys in later, often attracted by the story rather than the structure. That creates a strange outcome. A SPAC can experience massive redemptions, meaning much of the trust money leaves, yet the deal can still close. The target becomes public with less cash than the headline implied, and the remaining shareholders can face heavy dilution from sponsor promotes, warrants, pipe terms, and other embedded costs. The public investor thinks they bought a company at $10 a share. In reality, they bought into a cap table full of invisible mouths. Everyone gets fed, just not in the order that was advertised. This is the second secret of SPAC fever. Dilution is not an accident. It's part of the design. In the frenzy years, the market tolerated that design because everything was going up. When prices rise, structure feels irrelevant. When prices fall, structure becomes the entire story. And when the market turned, many SPAC-era stocks fell hard. Some drifted downward for months, some collapsed in weeks, some faced lawsuits, some faced regulatory scrutiny. Some faded quietly into irrelevance, not as scandals, but as disappointments that were inevitable once reality replaced narrative. The most telling part is that none of this requires villains twirling mustaches in a back room. The system doesn't need a conspiracy, it only needs incentives. If a sponsor is rewarded for closing, deals will close. If advisors are paid per transaction, transactions will multiply. If hype can attract capital faster than fundamentals can justify it, hype will be manufactured. And if public investors buy stories without understanding structure, the structure will do what it was built to do: transfer value upward through mechanics that feel like normal market activity. A SPAC is not inherently evil. In a healthier market, it can be a useful tool. It can bring public capital to companies that genuinely deserve it. It can offer flexibility for targets navigating uncertain conditions. It can create an alternative route for certain businesses when IPO windows are closed. But a tool becomes a weapon when used at scale under the wrong incentives. In the fever years, SPACs weren't just a funding method. They became a factory for public listings. They were a pipeline that turned private risk into public exposure faster than public investors could digest. They were a shortcut that bypassed some of the friction that exists for a reason. Friction isn't always bad. In markets, friction often acts as a filter. It slows down weak ideas. It forces scrutiny. It demands evidence. When the filter is removed, what flows through isn't only innovation, it's also noise. And when enough noise becomes tradable, it stops being noise. It becomes a product. That is what happened. The merger itself became the product. And products must be sold. So the language became euphemistic. A deal wasn't just a deal. It was democratizing access. It was bringing the next generation of technology to the public. It was disrupting traditional finance. Even when the underlying business was ordinary, the wrapper was revolutionary. This is a familiar pattern. When real growth is hard, financial growth becomes an industry. When building is slow, packaging accelerates. When the economy struggles to create new value, markets become more skilled at slicing and selling claims on future value. That's why the SPAC story connects to something larger. It isn't only about one craze. It's about a deeper habit of modern capitalism, the habit of rewarding paper more than production. When paper is more profitable than making things, the system attracts a certain kind of talent. Not builders, but deal closers. Not engineers, but storytellers. Not patient capital, but impatient leverage. And that's why SPAC fever looked like innovation while behaving like a classic cycle of extraction. For the public, the danger was never that every SPAC target was worthless. The danger was that the structure ensured that the most reliable profits were made before the truth could be tested. A transaction can succeed even when the underlying company fails. The closing can be celebrated even when the business is fragile. The press release can be triumphant even when the numbers are smoke. The public markets are supposed to be the place where reality wins, where quarterly results matter, where cash flow speaks louder than charisma. But SPAC fever exploited a window where the public markets temporarily behaved like a casino, where the value of a company could be derived from its category, its buzzwords, its futuristic renderings, and the credibility of whoever sat on stage announcing it. And then, slowly, the markets remembered what they are. When belief breaks, the spell ends, and the thing that seemed like a shortcut reveals itself as a rerouting of risk. The downside doesn't disappear. It simply changes hands. It moves from the sophisticated to the ordinary, from the early to the late, from the insiders who understand the machinery to the crowd that sees only the flashing lights. The blank check begins as a promise of access. But access to what? To the front end of a deal machine, to a structure where the cost of capital is attention and the price is dilution. A blank check is a beautiful object because it invites imagination. It tells people they're funding the future. It makes them feel early. It makes them feel smart. It turns investing into a kind of identity. But the market doesn't care how it feels to believe. The market only cares who gets paid. In the end, SPAC fever was not about making it easier to build great companies. It was about making it easier to take companies public, whether they were ready or not, and to extract value from the act of doing so. That's why the profits looked so effortless at the start. Because the early profits weren't created by business success. They were created by momentum, promotion, and a structure that rewarded the deal itself. And that's why the aftermath looked so predictable. Because once the public became the permanent owner of the risk, the only thing left was performance. The story had to become a balance sheet. The pitch deck had to become a cash flow statement. The dream had to become a company. Most dreams can't survive that transition. This is what remains when the fever fades. A reminder that finance is not magic. It is architecture. And architecture decides who gets sheltered when the storm comes. In every speculative cycle, there's a moment when people realize they weren't investing in a business. They were financing a process. They were buying a wrapper and hoping something real would appear inside. Sometimes it does. But the people selling the wrappers rarely wait around to find out, because the machine isn't built to ask whether the promise will be kept forever. It's built to keep the promise believable long enough for the transaction to clear. And when that belief finally breaks, the world remembers what a blank check really is. Not a shortcut to wealth, a test of who understands the rules and who only understands the story.